It's Dr. Berg. Looks like the collapse of the financial sector is imminent. I start to sell my position. It's 1.3 billion. Sure, I'll hold.
With financial headlines currently dominated by the latest bank to get into trouble, it's only natural to have concerns about the current banking crisis. What impact is it going to have on the property market and indeed our very lives? It was only 15 years ago that the credit crunch caused one of the biggest house price crashes in history. And so when the media is starting to use the same language that's been immortalized in the film The Big Short, it's time to really look at what's going on.
So you're offering us a chance to short this pile of blocks. How?
With something called a credit default swap.
So in this video, with the aid of a movie that I feel is essential viewing for any self-respecting property professional, and with an arcade machine full of toilet roll, I'm going to break down the following 3 things.
It's happening.
Firstly, what's actually happening with the banks right now? Secondly, is this an isolated incident or the start of a new banking wildfire? And thirdly, but probably most importantly for this channel, is what are the effects on the UK property market? So let's start by recapping what's happened so far and looking at the first domino to fall, that was Silicon Valley Bank. But before we dive into that, it's important to have at least a basic understanding of how our banking system works. Now, the technical term is fractional reserve banking. But in this video, what I want to do is just simplify the whole thing, because I know that the banking sector has a habit of overcomplicating things.
Mortgage-backed securities, subprime loans, tranches. It's pretty confusing, right? Does it make you feel bored or stupid? Well, it's supposed to. Wall Street loves to use confusing terms to make you think only they can do what they do. Or even better, for you just to leave them the fuck alone.
Okay, so very simply, we lend our money to a bank who look after it and hold it, and in return pay us a very modest interest rate on our funds. Those banks will take our money and then lend it out or invest it at a higher rate. Effectively, this is how they make money. A bank is just a business, has its own costs and needs to make a profit. Now, fractional reserve banking is a posh way of saying that the banks have to keep a percentage of our funds, essentially in cash, so that when we put our shiny cards in those holes in the wall, this coloured paper that we use to buy stuff actually comes out. So let's say that for every £10 that we put in, the bank's going to lend 9 of that out and leave £1 available for us to withdraw if we need it. And due to the sheer amount of money that banks hold, this system usually works just fine, apart from when everybody wants their money at once. And in this case, the banks won't have enough cash in their account to pay everybody what they're trying to withdraw. Now, having this cash available to withdraw is called liquidity, and banks start having issues if their liquidity drops.
I just wanted you to know that yes, Morgan has suffered some losses, but our liquidity is strong and there's no cause for concern.
So now we're all experts in the banking system, let's loop back round to Silicon Valley Bank. As the name suggests, this bank focuses on tech companies as their clients. And tech companies are usually pretty well funded and put large deposits into the bank. But 2022 was a bad year for the tech industry. And a lot of the companies had to take more of their deposits out to keep their businesses running and pay their staff. This meant that Silicon Valley Bank didn't have the liquid funds to pay everybody all the cash they wanted. So what they had to do was sell some of their investments to free up some capital. Now, some of these investments are called US Treasury bonds, which is the second concept that we need to run through. No, nothing to do with toilet paper yet, but what actually is a Treasury bond? Well, it's just a loan. Simple as that. When governments, banks, or even businesses need money, they issue something called a bond, which is basically them asking investors for money, which they'll borrow for a fixed amount of time. It could be 5, 10, 20 years, and they'll pay an annual interest rate on it. At the end of that time period, they'll pay the investor back the initial amount of money that they invested. So investing in a government bond is considered to be about as safe as it can be, because the chances that the government are not going to pay you back is hopefully pretty slim. Now, in the post-pandemic tech boom of 2020 and 2021, Silicon Valley had taken on a lot of deposits from new tech clients, and they'd invested those in about $21 billion worth of government bonds. Now, way back then, like 2 or 3 years ago, interest rates were low, and I mean super low. And what's happened in the last 12 months? They've shot up. Now, this may seem counterintuitive and the wrong way around, but as interest rates go up, the value of existing bonds go down. And this is because bonds can be bought and sold on secondary markets. Now, imagine for a moment that you own a bond that's paying you 2% a year. Now, for whatever reason, you need to sell that bond because you need to get your hands on cash quickly. But interest rates have now gone up. So all the other bonds on the market are at a higher interest rate. Let's say they're at 5%. Who's going to buy your crummy old bond that's paying 2% when they can just go out to the open market and buy one at 5%? Well, if you really want to sell it and you really need that cash, there's only one thing you can do. That's drop the price of the bond to make it more attractive to somebody. So essentially view this as a big seesaw. Interest rates go up, bond values go down, and vice versa. Of course, if you don't actually need to sell, this is never an issue because you just hold on to the bond, and at the end of that fixed term, you get all your money back. But in the case of Silicon Valley, they had to sell some of those bonds to release funds to pay the cash that their clients were asking for. Now, if we equate this to the property world, effectively the bank had turned into a motivated seller and they had to sell their investment below the market value to get their hands on cash quickly. And if you want to stay up to date with how to find motivated sellers in the property world, because I can't promise you I'm going to be able to find motivated banks for you to buy, then make sure you're subscribed to the channel because I'll be walking you through the whole property investment process in other videos. Now, because all of this banking stuff is regulated, Silicon Valley Bank had to tell the world they'd sold their bonds at a loss. And of course, this triggered the classic human response in a crisis: panic. And just as everybody ran to the shops to buy toilet paper when COVID hit, I told you I'll get toilet paper into this video, Silicon Valley Bank's customers thought the bank was in trouble, ran to take their money out, created the self-fulfilling prophecy of a bank run, and 48 hours later, the entire bank collapsed. So let's now look at the second domino, which was Credit Suisse.
All right, let's see what Credit Suisse's appetite is.
Now, this is a completely different scenario because Credit Suisse is seen as one of the big dogs of the global banking scene. But when we look more deeply, we'll actually see that Credit Suisse had been struggling with losses and scandals for years, if not decades. Now, I don't know if you remember the stories that came out a couple of years ago of David Cameron, our ex-Prime Minister, and a bit of a shady investment company that subsequently collapsed. Well, Credit Suisse was involved in that. Look, I'm not going to go into all the issues and scandals here, but let's just say that Credit Suisse was already vulnerable. Now, again, we saw a bank run on Credit Suisse, but this time the trigger was actually comments by their biggest backer, Saudi National Bank, who said they weren't prepared to put any money into the system. But this happened the week after Silicon Valley Bank went under, and so people were already nervous. Now, to stop a full-on meltdown, the Swiss National Bank injected an emergency fund of $54 billion to shore everything up.
Some of you may know Bear Stearns has just received a loan from JP Morgan. Of course, we're going to have to wait and see how the markets react, but that should lay to rest any concerns about the bank's health.
But this didn't work, and very quickly, the National Bank had to broker a deal for UBS to buy Credit Suisse at a value that was significantly less than it was worth a couple of days earlier. Now, I haven't even mentioned the demise of Signature Bank, which was overexposed to risky crypto investments. But the main question I want to ask is, are these isolated incidents or the start of a wildfire? Well, firstly, it's important to say that the world is totally different to where it was in 2008. Back then, there was a system-wide problem where many banks found that they were exposed to rotten investments in the US housing market.
Right now, every bank in town is unloading these bonds onto unsuspecting customers, and they won't devalue them until they get them off their books. This level of criminality is unprecedented, even on Wall Street.
After that crisis, the banks were told to hold more capital, and the regulations around risk were tightened up. Yet despite my efforts to make this video as simple as possible, banking is a little bit more complex, and so very often fragilities in the system won't be exposed until it comes under pressure. And right now, whilst there isn't an internal system-wide issue in the banking system, there is a common external threat that could just be the winds that fan the spark: interest rates. If we look at the financial crisis of 2008, the credit crunch in America led to the crash of property markets. This was triggered by a sharp rise in people with bad credit failing to pay their mortgages. A lot of people had taken on a lot of mortgage debt fueled by very cheap introductory rates. Additionally, interest rates in the US had to go up at the time due to inflation, and homeowners' affordability was hit by the rising costs of things like petrol and food. Not sure if any of this is sounding familiar. Now, of course, this led to a rise in mortgage defaults where people couldn't pay their mortgages. House prices dropped, and a lot of people ended up in negative equity, where their loans on the properties were more than the value of the house itself. This meant the banks themselves couldn't recoup their loans and so went bankrupt, and this sent a ripple out across the world. Now, as I said earlier, the world is different now. We're not in 2008 anymore. The banks have imposed much more rigorous affordability checks on people who are taking on mortgages to make sure this never happens again. But when we look at the picture right now, there are some concerning similarities. Over the last 3 years in the UK, we've seen a crazy property boom fueled by cheap money and quantitative easing. There's been a lot of people who have bought on short-term, cheap, fixed-rate mortgages which are now expiring in this year and next year. And we're also in a cost of living crisis with stubborn inflation and affordability dropping. And this time, the winds that might just fan these flames are the rapidly rising interest rates. Look, in the financial crisis of 2008, interest rates were slashed to almost nothing to save the day. Right now, they're still going up. Only time will tell on this one. We are already undoubtedly in a property market reversal. The question remains, how bad or deep will the banking crisis be in 2023, and what effect will that have on property prices? If we continue to raise interest rates, this will act like gravity on property prices and continue to bring them down. Things could get ugly. But we're also coming up to a general election in the next year or so. If things get too bad, will policies be reversed? Will money get pumped back into the system, which will inflate assets to a point where they could catastrophically fail further down the line, rather than a much needed and more gentle correction now to bring prices back in line with everybody's affordability?
I mean, they're gonna have to break up the banks. I mean, the party's over.
I don't know. I have a feeling that in a few years, people are going to be doing what they always do when the economy tanks.